Deep in the ocean, an orca pod is on the hunt. But these aren't your average orcas. These guys are organized.
Marketing team, did you get those social media posts scheduled for the SEAL migration?
Aye, Captain. We even have an automated notification for all pod managers when they go live.
They use Monday.com to keep their teamwork sharp, their communication clear, and their goals in sight. Monday.com. For whatever you run, even orcas. Go to Monday.com to dive deeper.
When you think about businesses that are selling through the roof, sure, you think about a great product, a cool brand, and brilliant marketing. But an often overlooked secret is actually the businesses behind the business, making selling simple. For millions of businesses, that business is Shopify. Nobody does selling better than Shopify. They're the home of the #1 checkout on the planet and the not-so-secret Shop Pay that boosts conversions up to 50%, meaning way less carts going abandoned and way more sales happening. So if you're into growing your business, your commerce platform better be ready to sell wherever your customers are scrolling or strolling, on the web, in your store, in their feed, and everywhere in between. Businesses that sell more sell on Shopify. Upgrade your business and get the same checkout Allbirds and Skims use. Sign up for your $1 per month trial period at shopify.com/start selling, all lowercase. Go to shopify.com/start selling to upgrade your selling today. Shopify.com/start selling.
Welcome back to another episode of Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to review some data that has come in. This is a very heavy data-driven week. We're going to take a close look at the US GDP for Q3, as well as numbers that came in from the private job creation sector. Before we get into that, let's take a look at how the markets are performing. As you all know, we are in the midst of earnings season. This week, we have begun to hear from tech companies. I am recording this episode as of midday, October 30th, and so we still need to hear from the majority of the tech companies, but who we've heard from so far. In fintech, we heard from SoFi and PayPal, and then yesterday evening, we heard from Alphabet. Today, we're getting ready to hear from Microsoft, Meta, 2 more fintech companies with Coinbase and Robinhood. We're also going to hear from Etsy and Roku. Tomorrow for the lineup, we have Uber, Peloton, Amazon, Apple, and Intel. And then on Friday, we slowed down with the technology companies. So it'll be interesting to see how this week shapes up. So far, Alphabet performed exceptionally well. This helped uplift the NASDAQ. The NASDAQ this morning hit a new all-time high. However, within the last hour or so, we have seen a complete reversal on the market. NASDAQ took back all of its gains, and so did the S&P 500. I do want to go over Google's earnings report and why it contributed to the NASDAQ reaching a new all-time high. Alphabet, very commonly referred to as Google, just like I did moments ago, is actually the parent company to Google. They have many subsidiaries under the umbrella of Alphabet. Some of the biggest ones and probably most common ones, of course, as you know, Google. There's also YouTube, Waze, Nest, Fitbit. Those are some of the most common ones. The highest grossing ones, of course, are number 1 with Google and then number 2 with YouTube. Let's take a look now at how the company performed for earnings. As I mentioned, it did exceptionally well. This is why we saw that increase in the NASDAQ. Earnings per share came in at $2.12. versus the $1.85 per share expected by analysts. Revenue came in at $88.27 billion versus the $86.3 billion that analysts were expecting. So it did blow expectations out of the water. But I think what is really positive here about Google earnings is how much revenue increased year over year. So Google Cloud revenue increased by 35% from a year ago, and their search business increased by 12% from a year ago. The search revenue, despite only increasing 12% from a year ago, is still the largest contributor to revenue for Alphabet. On the earnings call, Chief Financial Officer Anat Ashkenazi shared that they are planning to build on existing cost-cutting efforts. This is going to obviously help drive in more earnings. They are planning to use AI to streamline workflow and manage headcount of the company's physical footprint. He also said, and I quote, "I plan to build on these efforts, but also evaluate where we might be able to accelerate work and where we might need to pivot to free up capital for more attractive opportunities." I don't want us to move right past this quote. I want us to actually reflect on the quote, on how the CFO is looking to free up capital for a potential investing opportunity. There is an entire line item for revenue coming in from investments. Publicly traded companies are expected to invest their money, whether this is investing into other companies, perhaps private companies, but also in some cases, publicly traded companies. Most folks don't know that some publicly traded companies will buy shares from other publicly traded companies, or they will buy into other sectors like Bitcoin. So it's really important for us to pay attention to how these companies are maneuvering money and learn as much as we can from them. Switching gears here over to PayPal, a fintech company. They have reported a beat on earnings. Their earnings per share came in at $1.20 when analysts were expecting $1.07. Now, they didn't do so well on the revenue. The revenue came in at $7.85 billion versus $7.89 billion that was expected by analysts. Despite PayPal missing revenue expectations, it is important for us to note that revenue did increase from the same quarter a year ago. So we saw an increase of 6%. However, the market still was not happy. PayPal shares did drop from the news off of missing revenue. It dropped 7%. However, year over year, their performance seems to be pretty solid, coming in at 53% increase for the year. This is just the beginning of tech reporting for earnings. We'll see how the rest of the tech giants perform as we close the week.
This episode is brought to you by Global X. Since 2008, Global X ETFs has been committed to empowering investors with unexplored, intelligent solutions. Global X specializes in exchange-traded funds that offer exposure to the artificial intelligence ecosystem, including themes like data centers, robotics, semiconductors, and cloud computing. To learn more about Global X's entire suite of ETFs, from covered calls, fixed income, emerging markets, and more, visit globalxetfs.com.
My dad works in B2B marketing. He came by my school for career day and said he was a big ROAS man. Then he told everyone how much he loved calculating his return on ad spend. My friends still laugh at me to this day.
Not everyone gets B2B, but with LinkedIn, you'll be able to reach people who do. Get a $100 credit on your next ad campaign. Go to linkedin.com/results to claim your credit. That's linkedin.com/results. Terms and conditions apply. LinkedIn, the place to be. We
had Q3 GDP come in at 2.8%. This does signal that the economy is growing. However, this number is down from the previous quarter in Q2. In Q2, we grew our GDP by 3%, and analysts This quarter, we're expecting another 3% increase. We didn't meet that number. Some analysts are arguing that the economy is still strong, while others are focusing on the fact that the strength of the economy did drop by a few points. Another very important factor here is that the biggest contributor to Q3's GDP growth is the spending from the federal government. As a reminder, GDP stands for Gross Domestic Product, which is a measure of all the goods and services produced during a 3-month period. These are the goods and the services that we are consuming, buying into. And the measurement of the GDP also includes when the government spends a lot of money and consumes products or services. It is also important to understand that the number that we have for GDP growth is also made up of credit card spending. So if you purchase a good or a service on a credit card and you do not have the funds to pay back that purchase, this is also contributing to the number that we are calling growth for the country. So just some points here to take into consideration when we are discussing our growth. I personally think it is worth questioning if this is actual growth. We also received the ADP job report. This is data that is pulled from ADP, which is a private payroll company. So it is actual data that is coming in for this company. This is in conjunction with Stanford Lab, and it reports how many jobs were added to the private sector. This does not include jobs added to the government. The numbers that came in from the ADP job report are really astonishing, honestly. We were forecasting 110,000 jobs. In the previous month, we had 159,000 jobs added. We added 233,000 jobs. That is almost more than double what was anticipated. The market was really happy about these numbers. It does show strong job growth. Now, where the sectors grew is also somewhat surprising. We've been looking at this report ever since the start of the podcast, and most of the jobs added were always in hospitality and construction. Those were the two sectors that excelled the most. Let's take a look at the sector breakdown for this month's ADP job report. Education and health services came in at the top, adding 53,000 jobs. Trade, transportation, and utilities added 51,000 jobs. Construction and leisure and hospitality added 37,000 jobs. And professional and business services added 31,000 jobs. We do have another job report that is going to be released this Friday. Typically, ADP goes first, and then the U.S. job report goes second. They are capturing the same information in terms of how many jobs were added to the market. This report is from the U.S. Bureau of Labor and Statistics. The U.S. Bureau of Labor and Statistics also releases another report that we received earlier this week, not to be confused with the one we will get this Friday and the ADP report. I know, bear with me, we receive a lot of data this week and we're not even halfway through the week as of recording this audio. The U.S. JOLTS job openings. This is a survey that is also conducted by the U.S. Bureau of Labor Statistics. It helps measure any job vacancies. They collect any data from employers about their businesses. We were forecasting 7.9 million job openings. We came in shy of that. We came in at 7.4 million. In the previous month, we brought in 7.8 million. Now, this is negative given that we came in at less job openings than expected. Typically, when we have More job openings. This is considered positive because it means that the U.S. labor force is strong. There are opportunities and jobs available. So this is a negative number, but it is honestly not that bad, coming in shy from 7.9 million expected down to 7.4 million. That is all of the economic data I have for you this week. The next time I record another episode, we will have a new president of the United States. According to the stock market, Vice President Kamala Harris will be the next president. We will see next week if the stock market accurately continues to predict the presidential race. It is so important that we get out and vote. I know all of us have seen the vile rhetoric that came out of the Madison Square Garden rally. Earlier today, the Puerto Rican singer Nicky Jam walked back his endorsement for Trump. If you remember, Nicky Jam had attended one of Trump's rallies. Trump introduced Nicky Jam as a hot woman. He had no idea that Nicky Jam is actually a male. In a video on Nicky Jam's Instagram account, he shares that one of the reasons that he endorsed Donald Trump was because he felt that Trump would be the best president for Latinos to benefit from when it came to the economy. And there's something really important that I want to share here. The first thing is that the stock market has statistically performed better under a Democratic administration. It's important for us to understand that if the stock market is high performing, that is a direct result of publicly traded companies' high performance, which can only happen with a strong consumer. The second thing is that what difference does it make that the stock market performs better under a Democratic administration if we are not participating in the stock market? We need to participate. If we are so concerned about the economy, then we need to be more concerned about our education on economics, understanding how this country works, and participating in free markets. This country is founded on capitalism, whether we like it or not. And whether we like it or not, we are participants, some of the strongest participants. And so it is important that we not only participate in consumerism, but that we also participate in ownership. If we want to have more control over what happens with our money, then we need to understand how money works so that we can manage it better. While there are outcomes that we cannot control, it is important for us to take responsibility for the ones that we can control. And I don't know about you, but I certainly want my household, my family, my friends, my community to thrive despite who the president of the United States is. With that being said, let's not say stupid shit like I voted for a president because the economy is going to be better. When we live in a capitalistic world and we are able to make decisions on where we want to work, what we want to do for a living, and how we manage our own money. This is part of the privilege of living in the United States of America. The other privilege is making sure that we get out and vote and contribute to the outcome. Please go vote on November 5th. We're losing some of our most precious freedoms. I'm your host, Linda Garcia. You're listening to Investies, a Cosmic Standard and In Luz We Trust production. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.